Introduction to Investments. Investment is the employment of funds on assets with the aim of earning income or capital appreciation. No person would want to let go of his extra money on something that does not earn him anything. Most investors, if not all, put their money into any investment media with the objective of earning income. Investment has two attributes, namely time and risk. Present consumption, it says here, is sacrifice to get a return in the future. This core economic principle explains the trade-off between immediate gratification and future wealth creation, opportunity cost in investment, and saving. The two phases include number one, present sacrifice, that is now on saving or investing. Every unit of currency earned can either be spent on goods and services today or present consumption, or it may be set aside. Choosing to invest means deliberately choosing not to spend that money now on immediate enjoyment like buying new clothes, watching a movie, dining out, or taking a vacation. The second one is future return, which refers now to reward for waiting. Capital does not grow on its own while being consumed. It grows when you put productive use, like for example, buying stocks, issuing a loan, or funding a project. In exchange for giving up immediate utility, you expect to receive a return. The original principal plus extra compensation, which may be in the form of interest, dividends, or capital gains. The sacrifice that has to be borne is certain. You're sure about that sacrifice. However, the return in the future may be uncertain or not sure. This attribute of investment indicates the risk factor. The risk is undertaken with a view to reap some return from the investment. This fundamental investment concept highlights the unavoidable link between risk and expected return. No investor takes on financial uncertainty for its own sake. They accept it solely because of the potential reward. So when we talk about investment, of course, there's now this element of undertaking risk or the cost of entry. There is uncertainty of outcome. Unlike savings accounts with fixed yields, investments carry the risk that you might lose part or all of your principal capital. The type of risk may include market volatility, inflation risk, default risk, or liquidity constraints. Accepting this uncertainty is the necessary price for entering the market. Of course, investors now have the motivation of reaping return. Investors are naturally risk averse. They will not put capital at risk unless they anticipate generating a positive gain. Again, this may be in the form of interest, dividends, or capital appreciation. And of course, the investor's incentive would now be the compensation for both delaying consumption and, of course, taking on the possibility of loss. In this particular course, we are going to refer to investment as a monetary asset purchased with the idea that the asset will provide income in the future or will later be sold at a higher price for profit. Another way of looking at it, when current income exceeds current consumption desires, people tend to save the excess. This statement describes the fundamental engine of individual wealth creation and national capital formation. generating a financial surplus that naturally converts into savings or investments. And the dynamics of financial surplus involve number one, current income is greater than consumption desires or having surplus. Every individual or household like us earn a specific level of income over a period. When basic needs such as food and shelter and discretionary ones like that which we spend for our lifestyle are fully satisfied using less money than total earnings, a residual surplus remains. Another factor to consider is the tendency to save or capital accumulation. Rather than artificially inflating spending just to clear out the account balance, rational economic actors preserve this excess. This preserved surplus become now our savings. This become the primary raw material used for building emergency funds, purchasing assets, or making productive investments. And there are economic drivers behind that tendency. So the first one would be marginal propensity to save. As income increases, the proportion of each additional peso spent on consumption tends to decline, while the proportion saved increases. Another driver is precautionary motive. People save excess income to hedge against future uncertainties such as job loss, health emergencies, or economic downturns. And the last economic driver on my list when it comes now to this tendency is life cycle hypothesis. Individuals save surplus income during their peak earning years. So while you are gainfully employed, while you are still healthy and you can still work, okay? So you save the surplus income to fund consumption during non-earning periods, primarily retirement. Another possibility is people can give up the immediate possession of savings for a future larger amount of money that will be available for future consumption. This builds directly on the concepts of saving and risk by defining the core mechanics of investing, converting idle cash into active, growth generating assets through deferred gratification. So, giving up immediate possession, parting with the liquidity, holding cash or leaving money in a standard checking account gives you complete control and, of course, zero risk of nominal loss. When you invest, you deliberately lock that money away by buying stocks, bonds, or other investments like real estate, meaning you temporarily surrender access to those liquid funds. But of course, this is with an expectation of earning premium. Investors do not surrender control of their money for free. They require compensation or payment for both the time value of money and risk. The goal is to receive the original principal plus a return in the form of interest, dividend, or capital gains, so that future sum is, of course, larger. And then there's now the preservation of purchasing power. The ultimate goal of investing is not just to accumulate money. You don't just keep accumulating money, but maintaining or increasing purchasing power for the future. So whether for retirement, purchasing your properties, or funding education, a larger future amount is required to beat inflation. You know that. Ensuring that the goods and services you can buy in the future exceed what you could afford today. So it's important to grow your money. So as mentioned earlier, those who give up immediate possession of savings or those who are willing to defer consumption expect to receive in the future a greater amount than they gave up. So it's not that you're not going to buy what you want. You can do that in the future. Perhaps you have more money in the future to buy whatever you want then. You just have to be willing to wait a little longer. Conversely, those who consume more than their current income end up, perhaps in some cases, borrowing. Okay? So they must be willing to pay back in the future more than they borrowed. Moving on, the pure rate of interest, which is often referred to as the risk-free rate, is the baseline return an investor requires simply for delaying consumption over time, completely independent of risk, inflation, or administrative costs. It represents the fundamental price of time in financial economics. Notice that I have emphasized this phrase in red bold font so that you will not forget. So what are the core characteristics of the so-called pure rate of interest? You have zero risk exposure. So it assumes there is absolutely zero chance of default, loss of principal, or market volatility. Another characteristic is zero inflation impact. In pure theoretical terms, it is a real rate of interest, assuming price levels in the economy remain completely stable. Lastly, pure time preference. It reflects society's natural preference to consume goods and services today rather than in the future. So some are not really willing to defer satisfaction. If they want to buy something today, they're going to buy that no matter what. The pure rate is the minimum reward required to convince someone to wait. The pure time value of money is the economic principle that money available right now is worth more than the exact same amount in the future, solely because of the time factor itself, excluding factors such as inflation, investment risk, or default risk. It represents the fundamental human preference for present consumption over future consumption. And this would now include factors such as the opportunity cost of waiting. So having cash today gives you immediate utility. When you have cash today, you can buy goods, you can pay off your debts, or put it to work. Receiving that same cash later forces you to forfeit those immediate benefits. And then there's the reward for patience. Because individuals naturally prefer today over tomorrow, a rational person will only delay using their money if they are compensated with extra amount in the future. There's always that temptation to spend that money once that money is there. So if you are to defer consumption, then again, there should be a compensation, there should be a reward. And then there's that foundation of the pure interest rate. So this concept forms the foundation of pure rate of interest. The pure time value of money measures what it costs to persuade someone to defer gratification in a perfectly stable, risk-free world. Further, if the future payment from the investment is not certain, the investor will demand an interest rate that exceeds the nominal risk-free interest rate. Investors naturally demand a higher interest rate on uncertain investments because rational investors are risk averse. They require extra financial compensation, or what we call now a risk premium, for bearing the possibility that future payments may be delayed, reduced, or missed entirely. So we have the nominal risk-free rate. So this covers only the pure time value of money and expected inflation. It assumes 100% certainty of payment. And then you have the risk premium, or the compensation you get for uncertainty, the additional yield added to compensate for specific uncertainties. Examples of these uncertainties would be, for example, default risk, or the chance the borrower or issuer cannot make agreed upon interest or principal payments. Another example of uncertainty or risk is business or market risk. This would now be economic downturns, industry shifts, or poor company performance, which may now lead to lower total returns. And lastly, another example of risk would be liquidity risk. This refers now to the difficulty of selling the asset quickly for cash, just in case there's a need for cash. So you'll be having difficulty selling. So that is what we refer to as your liquidity risk. So again, the additional return added to the nominal risk-free interest rate is called your risk premium. We now move on to the characteristics of investment. Return is the financial gain or reward generated on an investment over a specific period, serving as the core motivation for committing capital and delaying consumption. The key dimensions of return include we have current income or yield, regular cash flows generated by the asset, such as dividend payments, bond interest, or for example, rental income are examples of current income or yield. And then we have capital appreciation. In some books, they make use of the term growth. The increase in the market value of the asset above the original purchase price upon sale is what we refer to as your capital appreciation. It's also important to see the difference between expected and realized return. So when we say expected return, the anticipated gain calculated before an investment is made based on forecasts, historical performance, and risk assessment. So sometimes this is what influences us to make now a decision whether to invest or not to invest. And then there's the realized return. So this is now the actual gain or loss earned after holding period, okay, or after the holding period ends, which may differ significantly from expectations. So, just like what we usually hear people say, expectation versus reality. So, the benchmark for performance when it comes now to this is that return provides a standardized metric, which is often expressed as a percentage of the initial investment. We will see more of this in other chapters, to measure efficiency and compare competing assets against one another or against inflation. And then, of course, there's that risk compensation. Return acts as the price paid to the investor for bearing uncertainty. As I've mentioned earlier, investors would want to be rewarded, okay, for taking on that risk. Because investors are naturally risk averse, higher potential returns must be offered to attract capital to higher risk investments. Otherwise, people will not invest if they don't, or if they're not sure that we're going to get something out of that investment. Next characteristic is risk. This is the variability or uncertainty surrounding the actual returns on an investment. Specifically, the possibility that the realized return will be lower than expected, or that part or all of the original capital will be lost. So what are the key dimensions of investment risk? This would now include deviation from expectations. Risk is not just about losing money. Remember that, okay? Risk is not just about losing money. It represents the range of possible outcomes. There are many possible outcomes. The greater the potential variance between expected return and actual return, the higher the risk. Another key dimension is the inseparable trade-off. Risk and return move together. Let me highlight that. Risk and return move together. Low risk investments, for example, government treasury bills and other instruments, yield low returns, while high risk investments like equities must offer higher expected returns to justify taking on the uncertainty. There are many different types of risk, but we are going to discuss the different types of risk in a different chapter. So the risk of an investment, it says here, depends on the following factors. I mean, other than those that were mentioned earlier. The longer the maturity period, the larger the risk. Imagine investing, for example, on a 20-year bond. Diba? A lot of things can happen within that 20-year period. The lower the credit worthiness of the borrower, the higher is the risk. So the reputation also of the one issuing, let's say, bonds, okay, or stocks matter. So if they do not have good reputation, the risk of investing in their company is higher. The risk varies with the nature of investment. Investments in ownership securities like equity shares carry higher risk compared to investments in debt instruments like debentures and bonds. That's why more often than not, we hear experts say that if you have low appetite for risk, it's better to invest in government bonds because this carry lower risk. But of course, it depends on other factors also. Another characteristic of investment is safety. This is the degree of protection an investment provides against the permanent loss of the original principal capital and its promised returns. It represents the certainty and reliability of an asset's value over time. So, what are the key dimensions of safety? One would be the protection of principal. A safe investment ensures that the initial money invested is secure and can be recovered intact upon maturity or upon liquidation. Another dimension of safety is the predictability of cash flows. High safety implies stable, predictable, and guaranteed income with virtually zero default risk. Another dimension of safety is inverse relationship with return. Safety and return are inversely related. Let me repeat that. Safety and return are inversely related. High safety means low risk, which directly results in lower expected returns, like in the case of, let's say, government bonds or government treasury bills, for example. And then there's that vulnerability to inflation. While safe investments protect nominal capital, they are often exposed to what we call purchasing power risk. If the return is lower than the inflation rate, the real purchasing power of the money diminishes over time. The last characteristic of investment on our list is liquidity. So it says on our notes, no, an investment which is easily saleable or marketable without loss of money and without loss of time is said to possess liquidity. So this is the speed and ease with which an investment asset can be converted into cash on short notice without suffering a significant loss in market value. So let me just highlight the two critical requirements: speed and price stability. So when we say speed, the ability to trade quickly. And when we say price stability, okay, selling at or near fair market value without being forced to take a steep discount. So we have the liquidity spectrum. Assets are either highly liquid or illiquid. So when we say highly liquid, this may now remind us of cash, money market funds, publicly traded large cap stocks, which can be converted to cash almost instantly at prevailing prices. And then we have assets or investments made, for example, in real estate, private equity, art, or specialized machinery, which often take months or years to sell unless the owner accepts a major price reduction. So for assets that are more difficult to dispose of, sometimes the only option is to lower the price so that people would now buy. Investors typically demand higher expected returns as compensation for locking up their capital in assets that cannot be quickly sold. Conversely, highly liquid investments generally offer lower yields. So, liquidity provides investors with an emergency cushion to handle unforeseen financial needs or the flexibility to quickly reallocate capital. Okay? Let me repeat that phrase: quickly reallocate capital to capture new market opportunities. So those are the characteristics of investments. For now, we end here and we will continue with the other part of this chapter during our next session.